In this recording, I'll cover the earned value technique as a project controls mechanism. So before we get started here, it's important to review the importance of having a project control cycle. Typically, the first step in developing your project controls is setting goals. And you set your goals by using your work breakdown structure to set a baseline for your project. So you set a baseline for your cost, a baseline for your schedule, and the second step is to measure your progress against the baseline that you've created for your project. And then the third step is to compare your actual against your planned baseline. And that's where earned value comes in. And then based on your findings or based on your comparison, you would then take actions to either speed up your project or manage the costs a little bit better if your costs are above your budget. So a reminder, a project is governed by three constraints, and the three constraints are cost, schedule, and performance. And earned value focuses on managing progress, tracking progress against these three constraints. Before we get into earned value, I'll introduce a couple of techniques used for project controls. Project S-curves is a technique that you can use to track the progress of your project. In this graph here, we see on the y-axis our costs, our cumulative costs for the project against the time or the schedule for the project on the x-axis. What the S-curve is telling us is, for example, at 15 weeks into the project, we should have spent about $20,000 on this project, and that's all it's telling us, how much money we should have spent at any particular time throughout the project's life cycle. It doesn't, however, tell us whether we are on track to complete the project or not. All it's telling us is what our spend should be at any given point throughout the project. So in this example here, we're showing that the solid line is your planned spend. Your dotted line is your actual spend on a project. And if you're doing a good job tracking that and monitoring your actual spend, you'll notice here at week 21 or so here, we are underspending against our budget, our planned budget. Knowing this information is not enough to let us know whether we are, for example, how much of the project we've completed. So based on this graph here, the project spend is about $80,000. At week 21, we've spent about $40,000. Again, we're not sure if we're in fact 50% done with our project. So that's the downfall of just relying on S-curves. So the S-curve focuses on tracking cost against schedule, but it doesn't tell us our performance against cost and schedule. And that's one of the drawbacks of only relying on S-curves. The next type of control tool available is the milestone analysis or a Gantt chart tracking mechanism. So milestones are events or stages in a project that let you know once you've reached those events. Typically, milestones are set against specific dates or against your schedule. So let's take a look here. This is an example of a project with milestones. So item number 5 here is a milestone. What this is telling us is by this date, February 9th, our bid review should be done. So it's tracking our performance of activities against schedule. And it doesn't tell us what our spend is per activity. So we're not able to track our spend or planned budget just by relying on a Gantt chart and milestones to control our project. So some challenges or drawbacks with using milestones. They're reactionary. You do not have a forward visibility or forward look in terms of whether or not you can achieve your planned schedule or your planned budget. So just relying on tracking controls, we're only tracking performance against schedule, and the cost doesn't come into the equation. Earned value, however, focuses on tracking cost against schedule against performance, and therefore gives you a better control tool to manage a project on the triple constraint. So here are a few terms we're going to be using while talking about earned value. First one is planned value. Planned value is your baseline. So that's the plan that you set for your budget and your schedule, and you would track against your planned value. For short, we will use PV to represent planned value. Earned value, for short, we'll use EV to represent that. Actual cost of work performed, we will use AC for short. So these are actual costs, is the actual invoicing or billings that you do on a project. Your schedule performance index, or SPI, the formula for figuring out your SPI is your earned value divided by your planned value. Your schedule performance index will tell you what your run rate is against your plan. Cost performance index, again, it's very similar to your SPI. The formula for that is your earned value over your actual cost, and this tells you your run rate or your spend rate against your planned budget. Budgeted cost at completion is a forecasting tool that allows you to estimate what your based on your run rate that you figure out from CPI, or your spend rate you figure out from CPI, what your actual spend could be or should be at the end of the project. So a few steps for using earned value. You need to define the activities, create the schedule, develop a time-phased budget, and do a diligent job of collecting your actual costs for the project, and then calculating your cost variance and schedule variance on an ongoing basis. And we'll see we'll see an example here in the next couple of slides. So this is an example of a project, and we're going to calculate the earned value for this project. So based on the steps that I've mentioned in the previous slide, the first step is to define your activities. So we have staffing, blueprint, prototype development, and so on. Second step was to create a schedule of when these activities will be happening. So staffing, by looking at this table, we know that there will be some activities in January, some activities in February, and the third step is to create your phased budget. So in January, for understaffing, we estimate that we will be spending $8,000. February, another $7,000. So the overall spend for the staffing activity would be $15,000. But a time phase budget, what that means is breaking down when your cash flow is going to happen. So having said that, let's start filling in some values here as we work towards figuring out what the earned value on this project is. So the first step is we need to figure out what our planned values are for each activity. So the planned value is right here. To figure out what our planned value is, we got to add up the total cost of each activity. So for the staffing activity, the planned cost is, as we mentioned, $15,000. For blueprints, the planned value is $10,000. For prototype, $10,000. Your full design, $21,000. Your construction is $32,000. Your transfer is $10,000, and your punch list is $20,000. So the total planned value for this project is $118,000. If we add up all these numbers, we'll get $118,000. Now the next thing we want to do is determine the cash flow on a monthly basis. So in order to do that, we'll look at our monthly plan, which is right here. So for January, where the plan is to spend $8,000. So we're just adding up all the numbers in the January column. February, $7,000. March, $6,000. For April, $17,000. May, $10,000. And June, $55,000. Now, in this example, we're trying to determine the earned value at the end of June. So we're looking at this project. This project continues on past June. It runs into July. So we need to figure out, in order for us to figure out the earned value at the end of June, we need to figure out what our planned value at the end of June is and what our actual cost at the end of June is. So the next step is to figure out what our cumulative month or our cumulative costs are for this project. So at the end of June, our cumulative costs are $8,000. So we're working on this row here. February, our cumulative cost is a total, to figure out our cumulative costs for the end of February, what we're doing is we're figuring out how much we've spent so far to date. So that would be using the January number plus how much we're going to be spending in February to get our cumulative costs in February. So what we're doing is we're taking the 8,000 spent by the end of January, adding the 7,000 that we plan to spend in February, and that would give us a cumulative value of $15,000. So again, looking at March, our cumulative planned value is the 15,000 that we should have spent by the end of February. Then you add your spend in March, and that would give you $21,000. Again, to look at April, we're taking the 21,000 plus the 17,000, and that would give us $38,000. May, we're taking the 38,000 to date in April plus the 10 in May. That would give us $48,000. Take the 48 spent to date in May, add the 55,000 that are planned for June, and you get a total of $103,000. So having gone through this exercise, we're determining what the planned value is at each month. So for this example, if the question is what is the planned value for this project at the end of June, so far we've already figured that out. The planned value is $103,000. So this is our PV. So I'll write it up here. PV is at the end of June. PV is 103,000. If the question was what is the planned value at the end of May, you'd look at your table again and pick out the number at the end of May. But in this example, we're looking at the end of June. So far, we figured out the planned value. Next, let's look at the cumulative costs. So in this row here, we have actual costs. So this is actual money spent on the project. So at the end of the month, when you do your invoicing, tally up the numbers. This is what your project accountant is giving back to you, and they're letting you know that this is how much you've actually spent on the project. So to figure out actual cost to date, again, it's the same method we use to figure out our cumulative planned value. So actual costs at the end of January are $8,000. Actual cost by the end of February, we're taking the 8,000 in January, adding the 11 spent in February, and that gives us an actual cumulative cost of 19,000 at the end of February. Carry on, 19 plus the 8 gives you 27 by the end of March. April, again, you take the 27, add the 11, and that's 38,000. 38 plus 10 is 48,000. Add the 30, you're at $78,000 by the end of June. This number here is our actual cost. So just looking at this so far, on this project, we plan to have spent $103,000. So far, we spent $78,000. The question is that a good sign or a bad sign? And at this point, we can't really tell. just by looking at these two numbers, we know we haven't spent the budget we were planning to spend by the end of June. The third piece of information we need to learn in order for us to determine whether this is a good sign or a bad sign is the earned value. The earned value tells us how much value we actually gained out of the work we've completed to date and the money we've incurred to date. To figure out our earned value number, we need to go through this next step here by determining our performance on the job. So, looking back on the first row, the staffing activity. The staffing activity has a planned cost of $15,000, and looking at our completion column, we know we completed 100% of this activity. So to figure out the value that we've gained so far, we multiply our planned cost by our percentage completed to get the actual value that we've earned on this project. So in this case, $15,000 times 100%, the value is $15,000. That's the actual value we have in our project. For the next activity, the blueprint, the planned cost is $10,000, and we've completed 80% of that. Therefore, the value we've gained on this project or on this activity is $8,000 of value. Next activity, prototype. Cost is $10,000. We've completed 60%. Therefore, the value we've gained so far is $6,000. Next activity is your full design, $21,000, and we've completed 33% or a third of that. Therefore, the value we've gained on this activity is $7,000. Construction values at $32,000. We've completed a quarter of that, or 25% of that. The value we've gained is $8,000. The next activity, transfer activity, cost is $10,000. We've completed 0%. Therefore, the value we gained on this activity is 0. And also for punch list, we've completed 0%. Therefore, the value we've gained is 0. Now, so far we've figured out the value we've earned on each of these activities in this project. To figure out the total earned value on the project to date, all we need to do is add up all the earned values we've determined for each activity. So 15,000 plus 8 plus 6 plus 7 plus 8, that should give us a total earned value of $44,000 for the project to date. So this value here is our earned value. By getting this third piece of information, we can make the assessment whether we're on schedule, behind schedule, ahead of budget, or behind on our budget. So the three numbers, what they mean is that planned value by the end of June, our plan indicates that we should have spent $103,000 on the project and earned $103,000 worth of value on that project. To date, our actual costs are $78,000. Therefore, we've spent less than what we had planned for. And the value we gained on the project is $44,000. So if the earned value is less than your planned value, that means you're behind on your schedule. and if your earned value is less than your actual cost, it means that you are overspending on your budget. So you spend $78,000, but the value you have in your project so far is only $44,000. So this is how you go about determining these three important pieces of information. So you could be asked to find out what the planned value to a certain by a certain day in a project, your actual cost or your earned value. But more importantly, what you need to the power of using earned value is there's the concept of using your estimated time to complete the project, and that's a forecasting tool. And estimated cost to completing a project, again, it's another forecasting tool. And that's important for you to determine whether you're going to be able to meet your project deadlines or not. In order for you to figure out your estimated time to completion and estimated cost to completion, we still need to work our Schedule Performance Index, SPI, and our Cost Performance Index, or CPI. So SPI, the formula to figure out your SPI value is your earned value number divided by your planned value. SPI tells you your current run rate at against your planned schedule. CPI, the formula for that is your earned value number divided by your actual cost number. What CPI tells you is your current spend rate against your planned budget. So using the numbers we've already got, our SPI in this case is going to equal to $44,000 divided by our planned value of $103,000. And if you do the calculations, that should equal to 0.43 or 43%. CPI, plug in the numbers, so our earned value is $44,000 divided by our actual cost of $78,000. That's going to give us, it's going to equal to 0.56 or 56%. Now we talked about the forecasting your estimated time to completion. The formula for your estimating time to complete is 1 divided by your SPI value times the total number of months for this project. Or if the project is measured in days, then it will be the total number of days for the project. Or if the project is measured in weeks, then you multiply it by the total number of weeks you've planned for this project. So this project that we've worked on is planned to go on for 7 months. So and we know that by looking at our table here, it goes from January all the way to July. Although we've only determined our planned value and actual cost to the end of June, this project is actually a 7 months project. So we would multiply by 7 months. So this equals 1 divided by 0.43 times 7 months, and that would give us, if we multiply that, that would give us 16.3 months. What this number is telling us is if we continue to run this project at the same pace we are right now, it would take us 16 months to complete the project. And similar value for cost, estimating cost at completion. So your estimate cost at completion is equal to 1 over your CPI value times your total planned cost for the project. So the total planned cost for the project is this value here, $118,000. So that's the entire cost of the project. So we multiply that by 118. So this equals to 1 divided by 0.56 times 118. And that should give us a value of 210.7. So the $210,000, what this is telling us is if we continue to spend at the current rate we're spending on this project, by the time we complete it, we would have spent $210,000. And that would mean that we're definitely over budget. And similarly for schedule, we're behind schedule. So that's how you would, when given this information, this is how you would go about determining your planned value, actual costs, earned value, determining your schedule performance index and cost performance index, and then forecasting your estimated time to complete and estimated cost to complete a project. So this is a completed example of the project that we just gone through. These are the values that we calculated based on the example that I've demonstrated. So here's a graph to kind of demonstrate what the numbers mean. So the solid line is our planned value for a project over time. Your actual cost is the actual money you're spending on the project over time, and earned value is the actual value you're gaining out of the work you've done. So you can think of actual value as, if you're building a house and you're spending money on building the house, and for whatever reason you have to quit the job halfway, and then you'd get an appraiser to come in and appraise the value of the house when it's halfway completed. You can think of that as your earned value. So you could have spent a lot more than what the current value of the house is, but if your client were to purchase it off you halfway through it being completed, they would only pay you the appraised value, regardless of how much you've actually spent on it. So that's one way you can think of earned value. So back to the graph here. The difference between our actual cost and our earned value is our cost variance. And the difference between our planned value and earned value gives us our schedule variance. So cost variance is equal to earned value minus actual cost. So when you do this calculation, if you get a positive number, it means that you're ahead of you're under budget. You're not spending more than you should be spending. If If you get a negative value, it means you're spending way more than you should be spending on this project. And that's how you would determine your cost variance. Your schedule variance is equal to your earned value minus your planned value. And again, very similar. If you get a positive number, it means that you are ahead of schedule. If you get a negative value, it means you're behind schedule. You're spending a lot more time than you should be on this project. So in the example I went through, we used a percentage complete rule for each activity. So there's a few rules that each company would set their guidelines in terms of how they would want to use completion values. So the three common completion values is the following: 0 or 100 rule. What this means is once you've started the activity, you mark it as a 0% complete, and the only other option you can mark it as is 100% complete, and you can only do that if you've actually completed the activity. So if you've completed half the activity, it will remain at 0. The only time you can update the completion is, or your performance is, once you've completed the project, or once you've completed that particular activity. The 50-50 rule means once you start an activity, you can mark it as 50% done, and then once you're done the entire activity, you would mark it as 100%. Percentage complete rule is based on an actual completion. So, for example, you'd be 27% complete. You can use actual values or completion values. 39% complete. You can use actual completion values. The trick here is, each organization would have their guidelines on which rules they would want to use, and depending on the activity, if it's a short activity, if the activity takes a day or less than a day, you probably want to use the 0 to 100 rule. If the activity spans several days or months, perhaps a percentage completion rule applies better here, because you have better ability to measure actual completion versus if it's a one-day activity. It's kind of tough to measure exactly if you're 30%, 39% or 51% complete. It's just an arbitrary value at that point. So it's much easier to just use a 0 100 rule. And that's kind of it for earned value and project using earned value for project controls.